Hello everybody, my name is Kate Olaf and welcome to my channel. In this video, I'm going to simplify how credit cards and credit scores work, tips you can use to boost your score, and the importance of having a good credit score. Take note that everything I go over in this video is universal. These tips will help you whether or not you have an 800 credit score or you have no credit history at all. With that being said, let's jump into the first part of this video. So to start, I want to explain what a credit card is. A credit card by definition is a small plastic card issued by a bank or business allowing the holder of the card to purchase goods or services on credit. The important take from the definition is that the holder of the card is able to purchase goods or services on credit. In other words, a person who uses a credit card is not using their personal money to purchase that good or service yet. They are using the issuer's money, aka the bank or business. You still have to pay that money back, but at the time your card is used, your personal money is not actually being removed from your bank account. So, to get a credit card, one must apply for the credit card that they want. This is a simple process that you can actually do online. If you don't currently have a credit card or have never had one before, credit issuers usually make it pretty difficult to get approved. In a sense, credit cards are kind of like students right out of college looking for a job. Companies will say that they want you to have job experience before you apply, but that's the reason that you're applying for the job in the first place. When you first apply for a credit card, you can run into the same issue. Without having any previous credit history, banks still want to see you have some credit history. But don't lose hope because there is a way around this, and it is known as secured credit cards. A secured credit card is simply a type of credit card that is backed by a cash deposit from the cardholder. Most secured credit cards have a minimum deposit of $200, and this deposit acts as collateral for the bank in case the cardholder can't make their payments. I personally have 3 secured credit cards and have been using them over the past year to help me get my foot in the door and start building my credit. Secured credit cards are still credit cards and will affect your credit score as if it was a regular credit card. The only difference between a regular credit card and a secured credit card is that a regular credit card doesn't need an upfront deposit. If you currently do not have any credit cards and are looking to get your first, I would recommend getting the Discover It secured credit card. It has no annual fees and offers a 1% to 2% cash back on purchases. This secured credit card was actually my first ever credit card and I still use it to this day. So now that you know what a credit card is and the types there are, I can now explain what a credit score is and how it works. A credit score by definition is a numerical expression based on a level analysis of a person's credit files to determine the credit worthiness of that individual. To simplify, a credit score is just a number that is assigned to a person that indicates how likely that person is to repay money. A credit score can range anywhere from 300 to 850. 300 being a poor score and 850 being a perfect score. Now in reality, if you have at least a 750 credit score, you won't have any problem reaping the benefits that a great score has to offer. However, any score below 629 and you may start running into some issues. So to simplify the whole process of a credit score, let me paint you a little picture. Imagine you had $1,000 and you had 3 friends you could choose to loan it to, and you ranked these friends' credit worthiness, aka their ability to pay money back, by a number system, aka a credit score. 850 being really good credit worthiness and 300 being really terrible. The first friend had a score of 300, the second 600, and the third 800. Who would you most likely lend your $1,000 to? Hopefully you choose the friend with the 800 credit score. This is how the credit score system in real life works. So now that you know how it works, let me give you the 5 factors that affect your credit score. The first is payment history, which accounts for 35% of your overall credit score. Payment history is simply the record of whether or not you paid your bills on time. The second is known as credit utilization, which makes up for 30% of your overall credit score. Credit utilization is simply the amount of your credit limit that you use. For instance, say you get the Discover It secured credit card and you put down the $200 deposit. That $200 deposit then makes your credit limit, aka your spending cap, also $200. And say within 1 month you only spend $20 on that credit card. Your credit utilization for that month would be 10%, which is a great credit utilization rate. Out of your entire credit limit on all your cards, you want to spend 10% or less a month to help boost your credit score and maximize your credit utilization. The third is your credit history, which makes up for 15% of your overall credit score. Credit history is simply the amount of time you've had open credit card accounts. Take Take note that banks will use the average time out of all your open credit cards account into consideration. If you are brand new to the credit game, you don't have much of a choice when it comes to credit history, but the sooner you get credit cards, the sooner your credit history begins. The fourth is your credit mix, which makes up 10% of your overall credit score. Credit mix is simply the type of accounts in which you pay off each month. There are three main types of accounts that a credit mix considers. These include installment accounts, open accounts, and revolving accounts. If you want, you can look into these three different accounts and figure out how they affect your credit mix specifically. But the simple conclusion is that credit mix is used to see how well you can manage different types of credit. These different types of credit can include an auto loan versus a mortgage loan versus student loan debt. And last but not least is number 5, which is credit inquiries, which accounts for 10% of your overall credit score. Credit inquiries take place when someone checks your credit, and there are two types of credit inquiries that can occur. A hard credit inquiry would be when a lender checks your credit for a home loan. A soft inquiry would be when you yourself check your own credit. Soft inquiries will not affect your credit score, but hard inquiries may have a negative impact. Hopefully now you can better understand how credit scores are ranked and how the algorithm works. So why is it important to know these things and obtain a great credit score? The ultimate answer is interest rates. When you have good credit, you'll be able to qualify for lower interest rates. Low interest rates mean that you can pay off loans quicker because the money that you're borrowing is cheaper. Let's go back to the story where we lend our friend $1,000. You would choose to lend that $1,000 to friend 3 with the 800 credit score. Not only would you choose friend 3 to loan that money to, but you would also make it cheaper to friend 3 by charging a lower interest rate. And you can charge the low interest rate to friend 3 because you can be confident in knowing that friend 3 will eventually pay every single penny back because of their credit score. If you chose friend 1, you would have to charge a higher interest rate because you can't be confident in knowing whether or not they'll pay all your money back. So when you have a great credit score, you benefit by obtaining low interest rates, and you also have a higher chance of getting approved for loans. So like I said at the beginning of the video, all these tips can help you whether or not you have an 800 credit score now or you have no credit history at all. A big tip that I tell people is that credit cards are not free money. Just because you don't pay for it the moment you swipe the card doesn't mean it's free money. You still eventually have to pay that money back. If you don't have the money sitting in your bank account, you should not be swiping your credit card. On the other hand, once you do get a credit card, you should never be using your debit card again. You always want to use your credit cards because they can offer you benefits that a debit card won't. So always use your credit cards and make sure to stay under that 10% credit utilization rate. And the most important tip that I can't stress enough is to pay your credit cards in full, on time, every single month. If you pay the minimum on your cards, the card issuers are going to charge you interest, and you're going to end up paying for more than you have to. This interest that they charge you is how the card issuers make their money. So don't let them fool you. Pay your credit cards on time every single month in full. I understand that I went over a lot in this video, and so if you have any questions, feel free to leave a comment below or message me on any of my social platforms. The links are in the description below. So with that being said, thanks for watching. Please like, comment, and subscribe to the channel if you thought this video was in any way helpful for you. Also make sure to tap the notification bell, that way you don't miss out on any of my new videos. And as always, I'm Kate Olaf, and I'll see you in the next one.